Hi everyone, welcome back to this episode with Jacob from JKR Investing for the second time because of some technical difficulties. But I appreciate you coming to chat to us, Jacob. You're one of the bigger UK stock market YouTubers, one of my stock market mentors that helped me learn about investing, stock picking, and kind of being in your Discord. So really appreciate you coming on.
Thank you for having me, and thanks for let's give it a second go and see if it works this time.
Yeah. So let's quickly kind of go back to the original question, which was what got you into investing and why was you kind of initially interested in the stock market? Kind of when did you get started?
So yeah, I think I got started investing around about 2016, 2017. The reason that why I got started investing is I was starting to work full time. I started to have a couple of side hustles that were doing really well, and because I was trying to save a lot of money, the side hustles were doing really well. There was quite a lot of cash that was sitting in my bank account, and it wasn't doing anything. And I was thinking, this cash is just wasting away. It's not doing anything for me. What can I do to get this cash to earn me more money? And I think one of the books that I read at the time, which was Rich Dad Poor Dad, I think that was one of the big things that pushed me over to kind of, I need to start getting this money to work for me to earn more capital. And one of the things that seemed like an easier thing to enter into rather than property, with property being a little bit more on the expensive side, is to try stock market investing because I could put lower amounts of capital in that. And I looked at the stock market investing in 2016, 2017, did a bit of research for a couple of months, and eventually thought, okay, I'll give this a go. Signed up to a platform. I couldn't use, even though I used Trading 212 at the time, which is really easy to use and it's very cheap to use. That was really focused around CFDs at the time, which I'm not sure if many of your users know what CFDs are. It's basically you're not actually owning the asset, and it's like a leverage product. So it's very high risk. And I had to use a platform called Jira, which I still use now. It's still, I think, it's still a good platform, just not as good as what Trading 212 is now with the ISAs as well. So I started using that platform in around 2016, 2017, and I started to have a little bit of success through that, using that platform and investing, and just kind of went from there, really.
Yeah, and I'm interested to learn a bit more. What kind of side hustles did you start with? Because side hustle is a bit of a buzzword now in kind of the finance space, and everyone's trying to find out the latest side hustle. And I think a lot of people, when they hear side hustle, they think, "Oh, it's a quick way to make money." But a lot of the time, it's almost like running a business if you want it to be successful, because there's so much competition online now, especially with online businesses.
Yeah. I think sometimes the side hustle word gets thrown around all the time, and it's makes it sound a lot easier. Go get a side hustle than what it actually is. Sometimes it can be quite tricky to find that niche that makes you a lot of money, because you look around. I mean, you see so many people nowadays that are going around the mobile phone scanning barcodes, trying to look to sell it on Amazon, or if they can find something they can make a bit of capital on. For me personally, the big one that I had the most success with was I was going through Facebook Marketplace. I was looking for products that I could sell on Facebook Marketplace that needed maybe something that needed fixing or repairing, that I knew what to do. I would repair them, and then obviously be able to upsell them. Maybe they just needed a lick of paint. Maybe they needed to look a little bit better. Maybe they're a little bit worn down. And yeah, I just refurbished products and then sold them back on either through Facebook Marketplace, through eBay. Sometimes Amazon was a little bit tricky with used products rather than new products. That was a tricky thing. And also Amazon, I don't think many people know this, but the actual money they take from selling a product is very high compared to a lot of other platforms, especially like something like Facebook Marketplace, where there's no commission. Or well, at least when I was doing it, there's no commission. I think it's still the same now. So that's that was the one that I had a lot of success with. I looked into what I think a lot of people look at, which was the aspect of wholesale, buying in bulk and then selling through eBay and Amazon. But the competition through that part of doing that directly was very tricky. I think that's what a lot of people go to, but there's already that much competition out there. It's really hard. So the big thing I found out is trying to find a niche that not a lot of people are doing, or you are the only one doing. And I think that's where you can have the most success from that.
Yeah, and you said you started to build up some cash. So did you, once you kind of started learning about the stock market, is it something you eased yourself into over a longer period, or did you kind of start putting in more and more money, and how did you gain that confidence?
Yeah, I think that's the big thing, isn't it? Confidence in the stock market. I think there's this view on the stock market that it's a very high, which it can be depending on your investment strategy, I guess. This very high risk Wolf of Wall Street kind of Leonardo DiCaprio style, and it's not really like that if you're a long term investor. It's far from that if you're a long term investor. Um, you can actually make long term investing quite safe if you wanted to go down that route. If you wanted, no risk. Obviously, there's views or places where you can go for a little bit of a higher risk investment. But for me personally, I obviously didn't know anyone that was investing at the time, which was very tricky to ask someone, "Oh, how are you doing? What are you investing in?" So it was kind of edging myself into where I can gain the confidence. And I think until you have an investment that does well, you don't really get that confidence until you've seen the positive. I could, like, for people that were buying like January, February prior to the CV situation, and then the stock market crashed in March and April. I could not imagine what they were thinking. They would be like, "What is this that I've just entered?" Or even people that maybe even invested in the last year, they would be like, "What have I entered this year? This is just awful. It just keeps going down and down." But lucky for me, I was actually, like I said, I was in 2016, 2017, which 2017 in particular was actually a really good market that year. And I just edged into, I think it was 6 stocks at the time. 6 stocks, which I think all of them, maybe apart from one, were all profitable companies, which I looked online and it seemed very clear that when I was doing a lot of research, looking into the likes of Peter Lynch, looking at the likes of Warren Buffett, they very much focused on profitable stocks, and those investors are proven to be very successful in the market. So I thought, okay, while I'm trying to build confidence, it seems to be buying into stocks that are profitable, growing the revenue, and then I picked 6 stocks, and obviously it worked out quite well, probably because it was a very kind market, but also those stocks did perform financially amazing through 2016, 2017 into 2018. And seeing them stocks, buying them stocks, doing the research and seeing them do really well. Especially at the time I bought a investment called Square, which is now named Block. I was buying Block at $20 or even in the teen range, something like that. And that went on to, I believe, in 2018, it went somewhere to like $45, somewhere around there. And just that was one of the big investments that I was like, whoa, I've just doubled my money from doing the research, and then I just sit back and let the company execute, and just seeing the wealth build up. I was like, this is what Rich Dad Poor Dad was speaking about. This is where I put my money to work, and they go work for me and bring in more money. Like this is it. And I think that was the confidence builder to kind of go, okay, this can work. This.
Yeah, and do you remember ever seeing kind of your stocks go on a dip? Those initial stocks you bought, and do you remember kind of your feelings? Because I think as a new investor, it does panic you a little bit when you start to see things go into the red. And how did you kind of have the confidence to keep holding them for the long term?
Yeah, without doubt. Like the first time you do really hit a dip in your investments as an investor, it it makes you a bit worried. Like as soon as you've been through a couple of dips, whenever you do get the next dip, then you have the more confidence to hold it through the other side once you make it through. I remember when I first started investing, and there'd be a day where it was down 1%, and I was like, oh, this is terrible. And then it isn't until you realise that there's just one day, and then I think the big reality check for me was 2018. In 2018, I think that we had it was never classed as a stock market crash because I believe it actually closed at like 19.9%. So I think obviously to be registered as a crash, it has to be 20% down on the S&P 500 to be registered as a crash. So it did go down 20%, but then because it didn't close 20%, it was like 19.9%. It never came down as a crash, and that's why I think the first crash into 2008 was only registered through the CV times when the CV dip happened. But that was a tough period. That 2018, that was around about a 20% drop on the indexes. Obviously, that caused a lot of individual stocks to crash more than that. Some individual stocks were down 30, 40% in that time frame. I remember Microsoft. I was looking at Microsoft. I think Microsoft was having a major dip at the time, which was very rare to see Microsoft have a dip at the time, and that was one that I eventually bought in that period of time. And that was the first time that I saw that, and that was, I think, around probably July 2018 to December 2018, and then it started to recover in 2019. But that was 6 months of just kind of going lower and lower and lower and lower. And that was the first period of time where you had a sustained time basis where it kept going lower and lower, and you're thinking this is just brutal when it just keeps going down and down and down and trying to make it through the other side. So yeah, that was the first time I had a bit of a dip really as an investing, and that, I think that toughened me up through for the CV situation when we went through that. And knowing that I'd been through that dip, even though I was a little bit more worried in the 2020 dip, because we never had anything like that, a pandemic like that. I think that situation then helped me get through the 2020, and then I think because going through the 2018 situation, going through the 2020 situation, going through what has been a tough year in the last 12 months in the 2022 stock market, I think what helped me get through that is then them two previous dips. And I think in the future, once again, I'll add this onto the list going, made it through that 2018 dip, made it through the 2020 dip, made it through the 2022 dip, and then whenever we get the next one, it just kind of gives you that more confidence to stay through the storm, I guess.
Yeah, 100%. I mean, you look at a lot of people who got into investing in the past couple years now have had to experience obviously the 2022 dip. I think it is sometimes the best way to learn is to actually kind of just stick through it, and a lot of people I think would have probably panicked, but now you've seen that even the start of this year the stock market started to rally again. So I think it really is a long-term game, as you say. So when you're kind of researching individual stocks, what things are you looking for in terms of like the financials and the valuation of the company?
So probably when I'm researching the stock, I think sometimes it gets it's made out harder than what it actually is, in my opinion. I think what you really need if you're buying a stock is two things. You need to have revenue growth. That is key. You need to have revenue growth, and then you need to have profit growth. If you have revenue growth and profit growth, or if you're even investing into maybe even growth stocks and you're unprofitable, they need to get to profitability. That is what you need to have when you're investing in stocks. And those two things, revenue growth and profit growth, are key. And even if you pay for a bad valuation in the company, as long as you have revenue growth and profit growth, they can get you out of sticky situations. And you might not make a lot of money because maybe you bought at a terrible valuation, but more than likely, if you have got the revenue growth and profit growth, they will get you out of them sticky situations. And those are the two things. Everyone makes it out harder than what it is, in my opinion, because those are the two things that you need to be staring at: revenue and profit growth. I think after that, once you identify a company that has revenue growth, profit growth, maybe a track history of delivering on that, the future plans on how they're going to deliver on that, then you start getting into more of the nitty-gritty stuff where that can really give you the maximum returns. So for me, they would be starting to look into things like the valuation. Valuation could be the difference between making a 10% return on the stock or you get a 100% return from the stock, which is then a little bit harder because no one has the same way to value a stock. Everyone looks at a different way to value a stock, and trying to find a valuation you're happy with, that's where it gets a little bit tricky, and that's where it gets into more of the detail of where you learn from experience and mistakes and how you can improve to value something potentially. So that's when I would say that's then your key driver of where your potential returns come from, and then potentially you start factoring on dividends. Is your dividend going to get hiked up? That can make a difference on your return. Your gross margins, your profit margins, because if you've got a company that stays flat on profit, but their actual profit margins go from 10% to 11, 12, 13, 14, 15%, just because they've increased the profit margins, the profit's going to start going up. And looking at margin increasing can be a major thing. Is your business going to go from 5% profit margins to 10% profit margins? That's doubling your profit. That's going to be a major difference in the bottom line. So then you're looking at things like, the margin's going to increase, shares outstanding. If you own a company, the company's diluting you as a shareholder, then there's more of a company out there, so then you own less of a company, and that's going to probably affect your return. If it's a company that is generating profit, which was spoke about just a second ago, because they're generating a good amount of profit, maybe that has a strong balance sheet. Because they've got a strong balance sheet, they're out there buying back shares. They're buying back shares. You're starting to own more of the pie because there's less of the company out there, and that factors in that. Obviously that's going to help your share return. So I think profit and revenue growth are your two things that you stare at straight away from a company, and then you add in all your little factors when you start doing a bit more research to be your key drivers for what that potential return can be.
Yeah, and you said, so do you go into a position you're looking to make 100% return on that individual stock? Obviously, a lot of people kind of who follow me who are more towards index investing, they're happy with like a 10% return per year. So do you think it's realistic and possible to beat the market as a stock picker over the long term?
Yeah, I mean, there's nothing wrong with index investing. If you want to have an easy life, if you don't want to do the research on individual companies, if you prefer to just buy in there and sit back and let it do the work, you're 100% doing better than most of the average Joe out there, because your money is still at work. You're still going to get a return, and you'll still do very well from that investment, more than the average person. So there's definitely nothing wrong with index investing. And for more than likely the average person, that is probably a very good way to be using your capital. For me, I looked at index investing, and then I looked at the individual stock picking, and I decided to go down the route of individual stock picking because I actually enjoy it. I actually enjoy researching into the company, seeing what they're doing, seeing that financial plan come into play, and the development of the financials, and also when you look at an individual company, a lot of the indexes own potentially that individual company, but you're just trying to identify in the index which of those individual companies is going to be, say, the top 10 performer in the S&P 500, which is going to be the top 20, one of the top 20 performers in the S&P 500. You're just trying to identify which is one of the key performers in there, and then you get the better returns from that. And that's just an example. It doesn't have to be a stock that's in the index, but that's realistically what you're trying to do. And if you are able to identify one of those opportunities, that's where you are able to then outperform an index investor. And that's the key thing that you're trying to do, is try and identify them companies that will outperform the index. And obviously, when you are trying to identify those companies, if you are able, or if you are successful to identify them companies, obviously they can majorly outperform the index. For example, you look at the likes of Tesla, for example. If you were able to identify Tesla as an opportunity before it went in there, all the S&P 500 shareholders own Tesla at the moment. But if you were able to identify Tesla, even probably, I think before the S&P 500 inclusion, I would guess it's probably still, when it came into the S&P 500, I think if you were able to identify that opportunity, I'm sure it would have outperformed the index, I believe. I know the share price has been really choppy at the moment, so I'm trying to think off the top of my head, but I think it would have done. But if you're able to even identify that before it came into the index, then obviously, you're majorly outperforming the index, and you're talking returns of 400, 500, 600, depending on what point you got into it. And that is obviously majorly outperforming the index. And that's that one investment, and that potentially lists your whole portfolio. The likes for me, the big one that what really pushed me, if this didn't, work out, maybe I would have rotated back to index, or being a shareholder in index, or buying index funds. Is Square. Yeah, I bought Square before it came into the S&P 500, and that stock went from $20, like I was talking earlier, $20, or it was maybe a little bit in the teen range, and that went up to $30, $50, $60. I think even, obviously, valuations got a little bit extended in 2021, but I think Square or Block went all the way up to 100 and, put me on the spot here trying to think about it, maybe 120, maybe $130. It went, extremely high, and you're thinking, there, the returns you can get can, majorly outperform the index. So I think that if you are able to identify the opportunities, that is where you can, majorly outperform the index. And I think that's obviously when you look at the likes of Peter Lynch, for example, that's what, when you listen to him, that he identifies them opportunities, and he were able to deliver them stocks that helped his portfolio outperform the indexes. So as long as you can do it, I mean, there's obviously got to be a point where if you're doing individual picking and you are at the point where you haven't identified any of those opportunities, then you probably go, well, I might as well go to index investing. But if you are able to identify them, then and you see the returns, then you can do it.
Yeah, so obviously running your YouTube channel, you get to see a lot of comments and kind of investor sentiment from the feedback you get on your videos. What are kind of the common misconceptions and mistakes you see people making, and like within the Discord as well? Do you see kind of regular mistakes people make when they're looking at individual stocks?
Yeah, I would say the biggest one I always see is share price chasing. And what I mean by share price chasing is that, sorry, if a stock is going up, they're looking at the share price going, oh, it's going up, this is an amazing investment, I need to buy more of this investment, when realistically, that investment can actually, not always, but that investment can be moving towards a stretched valuation. Maybe there's a lot of greed in there. And that is actually a time where you might want to be reassessing that investment that is maybe a little bit stretched and been on a bit of a two-run, and the valuation is a little high. The same thing is, and in particular, you see this during, saw this massively last year. Saw it briefly during the 2020 crash, but that was a very brief crash, so it wasn't really sustained. But share price is going down, and then people look at that company going, oh, the share price is going down, it's a terrible investment, don't buy that investment, that investment's going bankrupt. And sometimes the stock market and stocks and stock prices do crazy things. They do crazy things where prices go down and they shouldn't go down, or there's a massive overreaction. And then people look at that investment and go, that's a bad investment because the share price is going down. But realistically, if you actually stare, and there's a famous clip, I think, from Jeff Bezos that said this about Amazon a few years back. The share price is going down, but you look inside the business and everything's going up. The profit's going up, or the moving to profitability, revenue's going up, sales are going up, members are going up, users are going up. And there's a clip from Jeff Bezos, and he was saying at the time, like, Amazon stock the share price was going down and down, and he was staring inside the business and he was seeing all the internal metrics moving up. And he thought it's only going to be a matter of time before that's starts to be reflected in the share price, which is a really good clip. It's definitely worth watching, and that 100% can happen a lot of the time.
Yeah, do you think there's people who are too focused on the short term then? Because you're saying that obviously it's more important to focus on the inside of the company rather than the stock price.
Yeah, I think a lot of people claim to be like long-term investors, or say they're going to be long-term investors, and very quickly that share price movement can wipe that out. If it's gone down, oh, you know what, actually I don't like potentially this stock's down in a few months, oh, I don't like this investment, I'm going to sell out. Potentially a few people buy into a stock and then that stock goes up, and they start looking at that investment and go, "Oh, I'm up so much now. I'm going to sell out this position," and there could only be 20-30% up. When realistically, the stock could have the potential could be sitting on an absolute gem here that's going to bring them in plenty of returns in the next 5, 6, 7, 10 years. So yeah, I think sometimes people can be a little bit rash on what share price movements are and let them cloud that investment or how long they're actually going to hold that investment for. And I think if you are going to be truly a long-term investor, you are going to have the patience. And for me, when I actually do a lot of the YouTube videos, for example, it actually gets me looking at a lot of stocks and where stock prices have gone like every single day. And if it wasn't for me really doing YouTube, I would probably only log into my stock investing account probably like once every couple of months just to see where everything is. Because realistically, if I am really investing into something for the long term, I don't really need to know where that share price is right now. I don't need to know where it is in a few months. I don't really need to be looking at the share price. I just need to be looking at the reason why I invested into the company, and are them fundamentals, are the financials moving where I want them to be? And if the financials are moving where I want them to be, then that will be reflected in the share price in the long term. So I think that's the key thing as a long-term investor. A lot of people do get attracted into where the share price is up today, down today, when really it doesn't matter if you're a long-term investor. You want to see the financials play out.
Yeah, it's almost addicting, like looking at the stock prices every day because you're trying to find the perfect buy-in price if something has like a big down day, or quickly selling out shares if it has a big up day. So, yeah, do you think your approach, when you look at your kind of investment strategy, are you more towards growth, dividend value, or mixture? And how do you see your strategy changing over time, or are you kind of sticking to what you're best at?
Yeah, I'd say that originally when I started investing, I would say I was probably more towards a value play. However, I did have a couple of growth stocks, and then I think after seeing some of the growth stocks then perform very well, it was the realization that some of these growth stocks, even though they are higher risk, can bring in unbelievable returns, a lot more than what a value stock can bring in. For example, the one that I used earlier, which is Square, which then went on to do 200, 300, 400% return for me. The likes of Tesla, for example, when I bought Tesla in 2019, that brought in 300, 400% returns in for me. And the realization that them stocks, even though they do have them higher risk, can bring in the greater reward. And especially while I am still quite young at the moment, I can afford to take a little bit more of that higher risk, because if there was one investment that doesn't work out, then as long as I am still very successful at picking stocks, I can make up that error very easy, being at the younger age, as long as I have another successful investment. But ultimately, I have always tried to balance the portfolio out where I do have growth stocks, value stocks, dividend stocks, and I do prefer to have the complete free mixtures of them. I think if you can come the master of all three, that will be where you come the best investor, because there is opportunities where growth stocks are massively in favour and dividend stocks are rejected. There's times where dividend stocks can be in the popular one and growth stocks can be absolutely hated. The prime example will be 2021. Growth stocks were absolutely loved. Dividend stocks were absolutely hated. No one wanted dividend stocks in 2021. And if you were looking at them dividend stocks in 2021, you bought some opportunities. When we had the flip around and we had all these fears around the recession, we've seen a lot of the dividend stocks at the moment do absolutely amazing. You got the likes of McDonald's, which I think is very close to 52-week highs. You've got the likes of Pepsi, which I'm sure is near 52-week highs, or Coca-Cola, I think is near 52-week highs. You got the likes of Shell, for example. That's sitting at 52-week highs. Obviously, some of the energy situation would have helped that, and the record profits they're kind of putting in there. But it's another example of a dividend stock, which, if you look at 2020, 2021, wasn't really in favour. And when you look right now, a lot of these dividend stocks have rotated back into favour, and you look at a lot of the growth stocks in 2022, which have been impacted with everyone's rotated to the safer plays, and obviously the interest rates are pushing them down at the moment. And then you have the opportunities cycle now to the growth stocks. So there's always opportunities somewhere where you look for it. There's always opportunities in value stocks, dividend stocks, growth stocks, and that's why I like to have all three, because there's always going to be opportunities in some of them. And personally, for me, I have been a little bit more looking at the growth stocks right now. But even if you're on the UK side of it, you saw that in the back end of 2022, even the likes of the dividend stocks, they got crushed in November time when we had all Liz Truss coming in, and that created you getting dividend stocks on crazy yields, really low share prices. One that I wished I got an opportunity on that I should have took was B&M. I looked at that one. You're getting a really lovely yield on that one, really low valuation, and opportunities come out of anywhere. So as long as that's what I prefer to do, is have a mixture of the three. But I do always kind of move towards the growth stocks a little bit more, with me being a little bit younger and wanting to get them a little bit more of a higher return. I would say that probably when I do probably get a little bit older and I don't want to maybe risk the capital as much, or maybe not want to put as much time into the research, I might move to more of a passive investor, maybe a bit more of a dividend investor, where I can kind of sit back and not have to keep up where I'm researching every day on what's going on with this stock, and I kind of sit back and relax a little bit more. That might be something that I consider, but that's where I kind of sit right now.
Yeah, and where do you see the opportunity right now then in the market? Because you said, I think the growth stocks kind of got hammered in 2022, but there's also a lot of economic worries at the moment. So are you seeing any particular areas in the market where you think you're going to invest in, or are you still holding off a little bit because we've seen a bit of a rally this year?
Yeah. I mean, everyone's looking at the moment thinking it's a tough economic environment out there, but realistically, if you're a long-term investor, is this tough economic environment going to be around in 2025 or 2027? I mean, potentially it could be if it turns into something absolutely terrible, but realistically, I don't think this economic environment will be around forever. So it's trying to identify the opportunities for me that will be in a good position in 2025, 2027. And trying to find those opportunities where you look at what has really been beaten down at the moment and it isn't reflecting that future potential in the next few years. For me, when I look at the environment out there, there is some opportunities in the bigger market caps. They are a little bit harder to find. I think the likes of Google has been unfairly punished at the moment. The likes of PayPal has been pushed down a fair bit at the moment. So there is some big market caps out there that I think are good opportunities, but they're a little bit harder to find. Because, like I said, I think some of the stocks like McDonald's, for example, that's sitting very much near 52 highs that have quite a stretched valuation. And because of that, them sort of stocks being at very high valuations, the likes of, for me, when you look at the likes of the S&P 500, for example, the Dow, for example, they are a little bit extended compared to something like, if you were to look in the mid caps and the small caps, a lot of the mid caps and small caps, they have had a tough 2022, but a lot of them also had a back end of 2021, a really tough time as well. So a lot of the small caps and mid caps have actually been, which makes sense because when we do have a financial downturn, the small caps and mid caps always go before the large caps, but they also recover quicker. So it does make sense why they have had so much pain recently. But a lot of them have been having, I would say, 18 months of pain. And if you actually look at a lot of the small caps and mid caps, a lot of them were trading on like a forward earnings basis at the levels they were in 2008. So I've been looking at a lot of the opportunities in that sort of area. So that's mostly where I've been focusing at, is the small or mid caps. There's also a few UK stocks that have been really beaten down because of a lot of the things that have been going on. Brexit seems to be pushing a few issues on a few of the companies, or putting international investors potentially off from coming into the UK market. Also, the likes of the CV situation. Our economy has been a little bit weaker than, say, the US economy or a lot of the European companies at the moment, and maybe that's pushed a lot of the UK stocks down. Obviously, we've had a lot of changes in the Prime Minister. Seems like there's one nearly every week at the moment, which has finally started to calm down a little bit at the moment. So there's been a lot of opportunities where the UK market has also been a little bit weak. So yeah, there's definitely been a few out there, but those are the ones that I'm most focused on, I would say, at the moment.
Yeah. And do you remember kind of some of the mistakes you've personally made as an investor or stock investments that have gone wrong? Because I mean, I think everyone is obviously as a stock picker, it's impossible to get every single investment right. And I've, definitely got stocks which have gone wrong. For example, like I think Beyond Meat, I went. The management didn't execute. The hype around the whole kind of industry kind of died out. And as well, I think when I was a new investor, I remember selling out Greg's at a loss just because I didn't find it kind of as exciting as some other companies, and then it ended up 3xing from where it was. So, do you have any examples of things that have gone wrong in your investing journey?
Yeah, I mean, the big thing you're always trying to work out is you're buying into a company and then you're buying into that management team and you're staring at that management team going, right, my capital is with you. Can you execute on what you are saying? And then you as an investor have to realize that at no point a management team going to come out and say, oh, we've got a sales issue, or we're losing clients, or our profit is declining massively because of this factor and this factor, and it's probably going to continue. Management's job are always to protect the share price, and they're never going to clearly come out and say there's something going wrong with the business. And even if there is financial deterioration in that business, they're still going to be coming out and saying, yeah, everything's fine, we're going to do okay, or it's a little bit of a short-term impact. Management are there also to execute on business, but also to protect the share price. And your job as an investor is to look at that management team and go, is that management team executing on what I invested for? Are they executing on what they said they were going to do, what I thought they would do? And as an investor, it's always trying to find out. You don't really know if they are going to do what they said they're going to do until you've been in that business for a while. And then when you've been in that business for a while, you've got to kind of make that executive decision, looking at the valuation, looking at the financials. Are they doing what I wanted them to do? And then, it's kind of been a bit of a detective, really, and you've got to piece everything together and go, and trying to find out if there's any, smoke and mirrors, and do you carry a holding on to that investment? And I definitely think that, there's things that still take you by surprise when you've been in that investment, but you're trying to spot if there's anything going wrong with that investment. And with experience, you start picking up errors that you start noticing management team doing, or you start picking up errors early on where they're doing things that you don't like. So, for example, I was a shareholder in Beyond Meat as well, and you look at the likes of the signed a major deal with Pepsi, automatically thinking that's massive. They've got a deal with Pepsi. It's going to be really good. Sales are going to be brought in. The branding that's going to be there, and then unfortunately, it's something where it's really hard to pick up that they've signed a deal with Pepsi, but then they produce a product. The product isn't that good. The sales don't turn out to be what they should be. It's a product that is a very thin. In fact, I think it was I believe, a negative gross margin product. And then you look at the management team thinking, well, why have you signed a deal with a company that is going to then deliver negative gross margins? Now, you as an investor, at no point is there any public information out there where you can decipher that that is going to happen. That's something really hard to kind of pick up. But it's also, if you can look at the investments and go, our management team are making this, a prime example of one that you pick up is that or one that I had is like, for example, I bought into a company called AA Holdings, which was like an online gambling company, and they then bought William Hill. I looked at the valuation they paid William Hill for, and it was extremely high. And then you had a company that was moving from an online presence with very good gross margins, buying physical locations. They're buying these physical locations, and they're not very attractive physical locations. It's changing the business model completely. It's going to kill the profit margins and gross margins. And you're thinking, this management team has just made a terrible decision here. And then you start, using those detective skills of going, oh, I'm getting red flags from this, and this is not an investment as me as a shareholder wants you to do. I think this is going to financially impact the business. And for me, I sold out of that business. And for me, that was a really good decision, because since then, the share price has absolutely created since then. And that's just experience from learning from when you've seen companies that you've been in made acquisitions, when you realize, how much that business model is being changed by this decision from management team. And sometimes you're able to use your experience to help you avoid them bad situations. But sometimes, it is hard as an individual stock, and that is the risk of individual stock picking, is that it sometimes can be hard to spot the things that are going wrong inside that business.
Yeah, when you see a company's share price start to drop and it's a stock that you've spoken about before, do you see that some people kind of give you backlash in the comment section?
Yeah, of course. It's part of being in the public eye. If you have a stock that goes up, you're a god. You talk about Greg's, it goes up 100%. Oh, Greg's is absolutely amazing. You talk about Hims, oh, got this stock from you, or like which I hate when people say that. And Hims goes absolutely crazy. Oh, absolutely amazing, amazing pick and all this. And then if you have an investment that goes down, everyone goes, oh, don't listen to this guy. He doesn't know what he's on about. So it's part and parcel of the game. I always think that being a YouTube stock picker is a bit like a football player. You're only as good as your last game, and if your last game you picked a stock that did absolutely amazing, suddenly your best thing since sliced bread. If you had a stinker of a last game and a stock hasn't worked out, suddenly absolutely terrible. Shouldn't be doing it. Shouldn't be talking about stocks. It is what it is.
Yeah, what was it that inspired you to start kind of posting on YouTube, and what do you think about the YouTube stock market space now with some of the other creators and some of the other videos you see?
So yeah, when I started investing in 2016, 2017, there wasn't any really YouTubers on the YouTube site really. I think Graham Stephan just started at the time, but I think he literally had maybe like 30,000 subscribers, which is crazy to think about now. And on the UK side of it, there definitely wasn't any UK finance stock market YouTubers out there. So I just generally thought, okay, I didn't really have great amounts of knowledge. Like, these are my stocks. Some of them were doing really well. So I was more just kind of going, these are my stocks. This is what I'm investing in. This is why I'm investing into it. And maybe someone can follow my journey. Just sharing information that I had researched, and maybe someone else finds it useful. And that's originally why I started it. And it just kind of built up from there. So yeah, that's why I started doing YouTube and sharing it on the YouTube platform as someone to fill in that kind of UK stock investing gap, and sharing my research with people. I mean, the YouTube journey as a whole, or the YouTube scene as a whole. I mean, there's some really good YouTubers out there to listen to. Some people that do fantastic research that you can get a lot of information from. For example, I think probably one of my favourite YouTubers out there is Ali's World of Stocks. I think he's obviously a US investor, so that might not appeal to a lot of the UK market or UK investors, but the information and research that he puts on his YouTube channel is absolutely fantastic. Unrivaled Investing, I think, is another good YouTube channel that's out there. There's a lot of good YouTube channels out there that say, if you're thinking, oh, this stock looks a little bit interesting, let me quickly, get what's kind of going on with the business. quickly go to someone like their YouTube channels and they can give you, a really good backstory on it and go, all right, let me go take a little bit of look on this and see what I think. And there's some good YouTubers out there, but at the same time, the YouTube platform can be a space that is used for a lot of personal gain, potentially bad financial advice, and we especially saw that through the likes of 2021, and that can be the issue. I think because of the bear market, it has kind of shown who is kind of in it for the long term and who is actually giving more solid advice out there. I think that has been reflected in the last few months. So I think we're in a better place than where we were a few months ago, or should I say in 2021. Because I did think that the scene was taking a bit of a downturn, where it wasn't actually giving actual research and why I'm buying this stock and everything like that. It was just kind of more like, oh, this SPAC's coming on the market, this IPO is happening, and I think it's going to 10x kind of thing, where it got a little bit stupid. So yeah, I'd say that's where we're at the moment. So it's definitely in a better place.
Yeah, I mean, when we saw evaluations going so high, I mean, it was almost like you couldn't pick a bad company because everything was just going up and up and up. And now we've seen that once we've gone into a bear market, a lot of people have kind of disappeared. So I think, that obviously shows who's really in it for the long run and who was like trying to make quick money, I think.
Yeah, 100%. It was literally like, oh, they potentially could bring an EV vehicle out in electric vehicle out in 2 months' time. Oh, right, that's it. Stock's up 10%, or it could be a company that generally had no revenue or no profit, and it was this dream of what potentially they could produce, and the stock was going absolutely crazy. Yeah, it was an absolutely mental time.
Yeah, it was almost like if you put EV in if your stock was anything to do with EVs, it was just up 100%.
Yeah.
No reason.
Yeah.
How are you finding kind of balancing being a YouTuber? You obviously put a lot of time into your private Patreon group, creating videos there as well as having your job as well. And do you ever see yourself do you see yourself kind of investing more time into being your own kind of entrepreneur and putting more time into your kind of focusing, because you're making good money, I think, from you have some rental properties as well, right? Do you think you'll be working forever in a job, or do you see yourself kind of being more of a your own business owner?
Yeah, I mean, the good thing I always have is that I enjoy my job. So for me at the moment, I've always said that I enjoy it. That's my primary income, and that's what I'd focused on. And the YouTube side of it, for me, was never really about making any extra income from it, and I just did it for fun. So like when I first started posting videos in 2017, 2018, 2019, 2020, it wasn't really until 2020 where I was actually making an income from talking about any investments. I was doing nearly 4 or 5 years of actually getting paid nothing for it. So for me, it was never any for financial gain. I did it for 4 or 5 years for absolutely nothing at all. So I always just posted. I wanted to still do the full-time job because I enjoyed it. I posted the content because I enjoyed it as well. So I'm in a really lucky place where I still want to work full-time because I enjoy it, and I still want to make videos because I enjoy it. So at the moment, I'm in a good place, and also I was able then to obviously buy an investment property, which then also has done really well as well. So yeah, at the moment, there might be a point where it does make sense to change or have a swap around of what I currently do, but at the moment I'm just about handling the balance between it all. We'll see what happens, but I think that if I am going to probably extend anywhere, is probably to move a little bit more into the property market and maybe look at another property eventually down the line, maybe 12 months down the line if it's possible. I don't think it'll be possible at the moment with the how the environment is with the interest rates at the moment. But yeah, at the moment it's definitely balancing quite a few things. But I'm in a lucky place, and we'll see how we carry on doing going forward.
Yeah, I definitely think you could charge more for your group with the amount of time you're putting into kind of doing individual stock research, reviewing earnings, helping people with their portfolios, and for £5 a month, yeah, really good value in my opinion.
Yeah, there's been a few people that have said that, especially when you look at some people on the YouTube scene that are charging thousands for courses, and mine's only £1.25 a week or £5 a month. But once again, like it wasn't really about the money for me. I wanted to kind of create a solid UK group with try and put good content out there. So I just want to make. I don't want to be. It's trying to make it the price of a pint or a coffee, where it's not something that is crazy amounts of money, that is just affordable to the average person that wants to kind of find a group that they can consolidate in and talk about stocks and share ideas, which I think has been created. I think the group that we currently have is a very good group, and a few people have said to me before, especially with everything that's been going up in the last 12 months, about is there going to be some increase in price? And I think at the moment, I think it's a good price. I think hopefully the content I deliver on it is good content, and yeah, I just wanted to kind of fill the gap out there, and hopefully that carries on doing the job at the moment.
Yeah, amazing. And I think to finish off, I want to hear from you. What do you think are like the top 3 stocks that you're looking at in today's market that you think are really good valuations? And also, what do you think is like the top 2 things that people need to be aware of if they were to get into stock picking?
Oof. Top 3 stocks on at the moment. So, I mean, normally the likes of HIMS would be one that I'm really massive on, but it has been on a very good run. So from a valuation basis now, the likes of DraftKings, for example, I would say that for me, I think Google is, even though there's a lot of talk at the moment about the AI situation, I think is still attractive at these levels. And I think when you are a company that has the profit and the balance sheet that Google have, they will respond to this threat of AI. I think a lot of people think they're just going to sit on their hands and not respond to it or do nothing. They're in a good position, and they'll deal with it. And they still control a good chunk of the market share of the likes of the search engine, YouTube. So you want to be in a position where you control the market, not chasing the market. And that's what Google have. And I think they will respond to it. And I think Google at the moment is a very attractive valuation. And I've not seen a big blue chip at this attractive valuation for a long time. So I think Google is a very good opportunity. I've been buying a lot of PayPal at the moment. I think PayPal is a very good opportunity. It seems to obviously had a few impacts because of the whole boom from the CV situation, but and the eBay moving away from eBay. Looks to be in a good place now, where it's stabilising its revenue, it's stabilising, it's moving into profitability. Starting to throw off a lot of good free cash flow. It's buying back shares really heavy. It's got Venmo, which is the number 1 payment app, peer-to-peer payment app in the US, which is going to be obviously a growth driver for them. So I think PayPal is a very good opportunity at the moment. The third one, there's a lot of stocks that I've got going on in my head right now that I could say. I think recently, because it has had a couple of weeks where the share price has been declining and coming back to attractive value. However, saying that, it is a marketing company and we are due a trading update at some time soon. So we'll see what's said in that trading update. But S4 Capital for a UK stock seems a very attractive business because of the drop that's been on in the last few weeks. And they have financially been doing very well. So I'd probably go maybe S4 Capital. But yeah, that was a tough question. There's quite a few that I could put on this list. I had in mode very close as well, that I was very close to saying. I think that's very attractive values at the moment. So yeah, maybe them ones.
Yeah.
And I think what was the other part? Was it?
So if what's the top things people should be aware of if they do decide to kind of invest into individual companies?
I would say that don't chase the share price. Ignore the share price. Maybe not even look at the share price. With the share price, you'll be having, when the times are high, you'll have people saying it's absolutely amazing. It's going to carry on growing. It's going to carry on going up. There'll be people that get really excited because the share price is going up. When the share price goes down, there'll be a lot of negativity out there. You'll have to deal with the negativity. There'll be negative articles out there. There'll be everyone. If you can avoid it, that's great. But if you go on any YouTube comments, if you go into any forums, whether that be Yahoo or wherever you go, there'll be people saying it's a terrible stock because the share price is down, and is to not fall in the trend of people that are chasing or emotional because of the share price. I definitely say that's a big one that I think a lot of people fall for. The second one would be probably that diversification is key. I think quite often people commit 40-50% into a position when they first start, and then they realise that if that position does turn out to go wrong, which you can have with individual stocks, you are buying individual stocks, so that investment can go wrong. That investment can not work out, and if you have committed 40-50% of your capital into one position, that's a very expensive mistake, and you've lost potentially, or that 40%, 50% wealth that you had in that position. That's a big commitment, and that will take a long time for you to kind of get that financial or that wealth back from that mistake, and it's an expensive mistake to make. And I think that unfortunately some people don't realize that until they make it. So yeah, I think that diversification is key, because sometimes you see people say, I've got 80% of my portfolio in Tesla, or I've got 50% of my portfolio in Palantir, or something like that. I personally think that is a very high risk strategy, so I'd say diversification.
Yeah, I mean, I learned that the hard way as well, because I went quite heavy into Boohoo. So, but even though I still believe in the long term, obviously the share price has been destroyed, and so yeah, I definitely agree. Don't go all into one company too early, because the dip can always dip further.
Yeah,
That's the thing with the stock market. You can't predict how far things can go away from what's actually happening inside the company as well.
yeah. And it's one of those where, like, you can be the biggest bull on a stock, but something can happen that you don't expect. And you always have to have that in the back of your head. You can think this stock is primed to do absolutely amazing in the next 5 years, and then something comes out of nowhere, and I didn't expect that to happen. And because you didn't expect it, you've got way too confident. You put too big of an allocation in, and it can absolutely kill you. And even as you could be the biggest bull in the world on a company, but you always have to have that in the back of your mind that something might come out of nowhere, whether that be regulation, whether that be a competitor, maybe it'll be, very, very slim chance, but let's say financially they've done something not correct with their accounts, something really, basic like that. You've always got to have that, what if that 1% that you can't see happening happens? You don't want to be in that position where it absolutely destroys you.
Yeah. So yeah, all really good advice, and I think that's pretty much everything I wanted to cover. Unless there's anything else, I think I really appreciate you coming on to chat. And where can people find out more if they want to kind of find you online?
Yeah, I mean, they can go onto YouTube, JKR Investing, or just follow on the Instagram, which once again is JKR Investing, if they want to see more content from me. And thanks for having me on, Fergie.
No, I really appreciate it, and yeah, thanks very much.